Welcome to Iron Financial. I am your lead analyst, and my mission today, as it is every single day, is to help you forge a stronger, much more resilient portfolio. We are here to cut straight through the market weakness and find the companies that are actually built to last. Now, in this explainer, we are putting an absolute massive player in the restaurant sector under the microscope. We are looking at Texas Roadhouse. That's ticker symbol TXRH. We are going to stress test their financials, hammer out the exact details of their recent earnings, and really figure out if this company is built on a solid foundation or if it's just coasting on past momentum.
Market skeptic.
And joining to make sure we don't just blindly buy into the corporate hype is your resident market skeptic. Look, I am here to ask the incredibly hard questions. Because right now the macro environment is brutal. Is this company's growth actually real, or is it just a fragile house of cards waiting to completely collapse under inflationary pressure? Let's get to work and find out. So, the crucial question we're answering today is simply this. Is Texas Roadhouse an ironclad investment? From my bullish perspective, we are looking at an absolute powerhouse of a business. We are talking about massive top-line revenue growth, rapidly expanding physical footprints across the country, and parking lots that are literally packed to the brim every single night of the week. That kind of demand is heavy duty.
Yeah, well, as the skeptic, I am staring relentlessly at the bottom line. Because let's be entirely clear here, okay? Top-line growth means absolutely nothing if margin weakness is bleeding out your actual profits. You can sell all the steaks and rolls you want, but if it costs you more to cook them than you're actually charging the customer, your structural integrity is completely compromised.
That is a fair point. So today, we are going to pit these two exact narratives directly against each other. We're pulling data straight from their 2025 annual report and their latest Q1 2026 SEC filings to see who's right. Before we dive into the raw numbers, to really understand the sheer scale of the operation we are dealing with here, let's establish the physical footprint. Texas Roadhouse isn't just your local neighborhood steakhouse anymore. It is a casual dining giant that is currently testing the structural integrity of the entire restaurant sector. By the end of Q1 2026, they were operating over 820 system-wide locations, and that's spread out across 49 states and 10 foreign countries.
See, that massive scale is exactly what makes me so nervous right out of the gate. When you have that much physical footprint, when you have that much heavy logistical overhead stretching across international borders, you're incredibly exposed to global supply chain crunches. Managing daily distribution for over 800 restaurants means every single ripple in the freight or commodity market hits your balance sheet incredibly hard. When they report their numbers, it's not just about selling food, it's a direct read on both the strength of the consumer and the crushing weight of modern supply chain economics.
Let's move into Section 1. Top-line heavy lifting, forging a $5.9 billion top line. As your lead analyst, I always want to see if a company can actually generate cold, hard cash at the register before we start worrying about what happens in the back office. And when it comes to forging a massive top line, Texas Roadhouse absolutely brought some serious heavy machinery to the job site in 2025. Back in 2024, they posted a very respectable $5.37 billion in total revenue. But in 2025, they hammered out a massive 9.4% revenue jump. That brings the top line to nearly $5.9 billion. It was $5.88 billion, to be exact. Let's be real. A nearly 10% jump on a multi-billion-dollar base is not an accident. This heavy lifting was achieved through a highly calculated combination of increased physical foot traffic and some very strategic menu pricing that they implemented during the second and fourth quarters of 2025. They pulled the levers, and the revenue engine absolutely roared. Now, I want you to focus on this number, 60. That single number represents 60 consecutive quarters of comparable restaurant sales growth. That is, of course, if you logically exclude the massive, unprecedented structural disruption of the 2020 lockdowns. Just let that sink in for a moment. 60 quarters. That is a 15-year streak of continuous year-over-year demand growth going all the way back to 2010. You know, in the restaurant industry, which is highly volatile, intensely competitive, and notoriously prone to sudden, aggressive shifts in consumer taste, maintaining that level of consistency is incredibly rare. Actually, scratch that. It's almost unheard of. That kind of unbroken consumer demand over a decade and a half is the very definition of a solid, ironclad foundation. Let's break down the localized unit volumes to see exactly where all this horsepower is being generated from. Across their entire consolidated portfolio, they boast an average unit volume exceeding $8.4 million per year. The namesake Texas Roadhouse brand, it's churning out over $166,000 in average weekly sales per unit. Bubba's 33, which is their sports bar concept, is absolutely pulling its weight at roughly $122,000 a week. And then you have their newer fast casual concept, Jaggers, which is generating roughly $73,000 weekly.
Okay, I will definitely concede that $166,000 weekly for the flagship brand is undeniable brute strength. That's a massive amount of stakes. But let's look at Jaggers for a second. At $73,000 a week, is that concept really pulling enough weight to justify the intense capital expenditure being poured into expanding it? I mean, we really have to wonder if every single beam in this corporate structure is actually supporting the overall weight, or if some of these side projects are just dragging down the margins.
Look, that is a perfectly fair question to ask, but management is aggressively backing that expansion because they see the structural upside. In 2025 alone, they literally poured concrete and raised steel for 28 brand new company restaurants. This included 20 Texas Roadhouse locations, 7 Bubba's 33 locations, and yes, they are actively expanding the Jaggers footprint. You have to understand, pushing forward with intense physical expansion during a period of high inflation requires immense confidence in your structural demand. While competitors are out there pulling back, pausing development, and hoarding cash out of fear, Texas Roadhouse is laying down the infrastructure right now to capture even more market share in the future. But here is what I consider to be the absolutely most critical metric for the entire top-line argument. Anyone, and I mean anyone, can artificially inflate their revenue by just jacking up prices on the menu. That's a mirage. It doesn't represent true business growth, it just represents inflation passing through. But Texas Roadhouse actually saw a 2.8% increase in real physical foot traffic in 2025. That means more actual human beings drove to the restaurant, walked through the physical doors, and sat at their tables, completely despite a challenging macroeconomic environment. This proves that their base demand is solid steel. It really separates them from the competitors out there who are just trying to mask a shrinking customer base with aggressive price gouging. All right, well, it's time for Section 2, cracks in the armor. We need to test the structural integrity of this narrative. This is exactly where I have to step in and aggressively halt this bullish parade. Top-line revenue is fantastic for the shiny headlines, but if the underlying cost to actually build the product is skyrocketing, the bottom line is going to bleed out fast. We have to thoroughly test the structural integrity of those margins. I want you to juxtapose these two realities for a second. On one side, yes, you have a solid 4.9% full-year same-store sales growth. That's a great metric. But on the exact same token, look at the crushing weight dropping directly onto their balance sheet in the fourth quarter of 2025. We're talking about 9.5% commodity inflation. 9.5%. That is the cost of beef, the cost of core ingredients, the raw materials required to literally forge their product. This isn't a tiny headwind. This is a massive structural threat trying to blow the company's safe apart from the inside. Let's drill deep into this Q4 2025 earnings drop because it is ugly. Income from operations completely fell through the floor, dropping 30.2% year over year down to $96.7 million. Net income? That dropped almost 27%. Diluted earnings per share plummeted over 26% down to $1.28. And the restaurant margin itself, as a percentage of overall sales, shrank a massive 309 basis points down to just 13.9%. Now, for anyone new to this, or anyone who doesn't run a P&L every day, a 309 basis point drop is over a 3% pure loss in margin. In a notoriously low-margin business like casual dining, dropping to 13.9% isn't just some small cosmetic crack in the armor. It is a serious breach in the hull that demands immediate, critical attention from management. And it gets worse, because adding a heavy secondary stressor to this margin compression was wage and labor inflation. That ticked up 2.9% in the fourth quarter alone. So what we're looking at here is Texas Roadhouse fighting a brutal dual-front war. On the left flank, you are paying significantly more for the raw materials, specifically the massive amount of beef they go through. On the right flank, you are paying significantly more for the human labor required to actually prep, cook, and serve that product to the customer. So yeah, the top-line revenue went up, sure, but the underlying cost to construct the final product was absolutely eating the profits alive by the end of 2025. Furthermore, let's talk about the capital expenditure costs. I'm talking about the actual physical cash money required to build a new infrastructure. It's rising significantly. In 2024, it cost roughly $8 million to build a new Texas Roadhouse location. Fast forward to 2025, it was $8.3 million. And now, the company actively projects that the average capital investment to build a single new location in 2026 will hit $8.9 million. Why? Because of drastically higher rent and much heavier building material costs. So I have a direct challenge for the lead analyst right now. If it costs almost $9 million to build a single restaurant location today, how long is the payback period on that investment? Is this aggressive expansion pipeline actually just a massive debt trap waiting to snapshot when the economy cools off? All right, let's address that in Section 3, Q1 2026, the steel hardens. Rebounding from the anvil. Look, I hear the skeptics challenge loud and clear, but as an analyst, I don't just look at the damage a company takes, I look at exactly how a management team responds to the impact. The Q1 2026 data shows a rapid, incredibly aggressive turnaround that directly answers those margin concerns. Just look at the numbers. Total revenue climbed 12.8% to over $1.62 billion for the 13-week period. But far more importantly, the bottom line absolutely stopped bleeding. Net income popped back up 8.6% to $123.4 million, and diluted EPS rebounded sharply to $1.87, which is a 9.6% increase. They took an absolute hammer blow in Q4 from inflation. They immediately adjusted their operational stance, and they hardened their financials to protect profitability going into 2026. And honestly, nothing signals a management team's confidence in their structural integrity quite like a massive dividend hike. In early 2026, the board of directors approved an aggressive increase to their quarterly cash dividend, raising it from $0.68 all the way to $0.75 per share. That represents a powerful 10.3% increase in shareholder yield. Think about the mechanics of this for a second. When a company is actively pouring $8.9 million into expanding its physical footprint, while simultaneously returning much heavier yields directly to institutional and retail investors, that is an ironclad signal of confidence. They know their ongoing operating cash flow can easily support both the heavy lifting of expansion and rewarding their shareholders. Let's unpack the underlying metrics that actually provided this Q1 structural strength. Comparable sales growth at company restaurants hit a massive 7.1%. They generated a whopping $259 million in pure operating cash flow. And crucially, this is the most important part. While food and beverage costs remained a heavy pressure point at 35.3% of sales, they managed to decrease their labor costs down to 32.9% of sales. This right here is a textbook example of positive operating leverage. Because their top-line sales grew so incredibly fast, it successfully diluted their fixed labor costs down to a much smaller percentage of overall sales. That leverage is the financial mortar holding the bricks together despite the intense inflationary heat. Okay, but wait a minute. To fight the ongoing 6 to 7% commodity inflation that's expected for the rest of 2026, management deployed what you like to call a tactical countermeasure, which was a 1.9% menu price increase in early April. I have to ask, is a tiny 1.9% hike really enough to absorb 7% commodity inflation, or are they just terrified of scaring away the foot traffic so they're kicking the can down the road? It's exactly enough when it's combined with their massive, overwhelming volume. It's a highly calculated, marginal hike. It's designed specifically to absorb just enough of the inflationary heat without fracturing their core value proposition. If they raised prices 7% all at once, yeah, they'd drive away that vital foot traffic. By doing 1.9%, they protect the guest experience while using sheer transaction volume to make up the difference on the back end. And despite all the macroeconomic headwinds and all the skeptics' very vocal worries, the expansion pipeline remains wide open. By the end of Q1, they had already opened 7 brand new company restaurants in 2026, with an additional 22 under heavy construction. Furthermore, literally right on the first day of the 2026 fiscal year, they completed a massive $72 million franchise acquisition. They brought 5 highly profitable domestic franchise restaurants entirely in-house. That is a bold, aggressive move. They are doing this to capture the full restaurant-level margins directly onto their own balance sheet instead of just settling for a tiny fraction in royalty fees. They are aggressively building out the brand portfolio because they know the foundation can handle the weight. Lead analyst. Section 4. The verdict. Opportunity or trap? Let's bring it all together. So we have seen the undisputed top-line horsepower, we have seen the very real painful margin compression in late 2025, and we have analyzed the rapid cash-generating turnaround in early 2026. The perspective from the top down is incredibly clear. CEO Jerry Morgan stated, "We kicked off 2026 with terrific momentum thanks to the hard work and discipline of all our operators." I want you to focus on that word, discipline. It is absolutely vital here. In an economic environment where the cost of beef and building materials is actively trying to crush your margins, operator discipline at the local individual restaurant level is literally the only way to maintain the value proposition while still generating a solid profit for the shareholders. Here is your Iron Financial summary for today. The top-line argument is crystal clear. The company forged a massive $5.9 billion top line through real, physical traffic growth. They aren't faking it with just price hikes. And they demonstrated a rapid turnaround in Q1 2026, popping the EPS back up and expanding the dividend yield to 75 cents.
But on the flip side, as investors, you absolutely cannot ignore the structural threat here. They faced intense, very real commodity margin pressure that caused a significant, painful bleed in Q4. It's a top-line powerhouse battling very heavy, escalating margin costs. The ultimate question is if sheer transaction volume and highly strategic micro-pricing are really enough to continually outrun inflation long-term.
We have laid out the blueprints, we've analyzed the structural integrity from the foundation up, and we've highlighted both the immense strength and the obvious pressure points of Texas Roadhouse's financials. The numbers are clear, the strategy is fully in motion, and the data is right in front of you. But the final decision? That always rests with you and your personal risk tolerance. Look at the data we've covered today. Are you buying the breakout right now, or are you waiting patiently for a pullback?
I'm your market skeptic.
And I'm your lead analyst. Decide if TXRH actually belongs in your fortified portfolio, and as always, keep building.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.